Hey guys, this is day 76 of startup. I'm close to registering a company in USA and I came across this 83B election tax law that you have to know about, or else you might literally lose millions of dollars in taxes. So first of all, I want to tell you that if you plan to do business in USA, and especially if you're doing a B2B software as a service SaaS company, then of course you should plan to do business in USA because that's where the market is. And then if you're selling to US customers, then you should register a company in America, the parent company in America. And it is also easier to raise funds from America. So that is again one more reason to register a company in America. And as we discussed last time, register it in the state of Delaware. After registering the company, do not forget to issue yourself shares, or maybe you'll need to buy these shares, of course, at a very small, like $10 or $20 kind of price. Now, I want to tell you about a concept called vesting if you do not already know. If you know, you can forward this section, but vesting, so you own or you deserve to own this, let's say 100,000 shares of the company, which is equal to 100% of the company right now. So yeah, these shares belong to you, they're reserved for you, but actually you do not get them all in one go. Investors, future investors, actually, even if you're a solo founder, future investors will like that you get these shares little by little over the period of 4 years, so that if you decide to leave in between, then they can still give some of those shares to someone else to run the company, and they don't want someone to just leave the company and own still the shares. And in case of multiple co-founders, of course, it's very important even for the founders, other founders who are remaining, that only the people who work get more and more shares. So that is why this vesting period is added. A concept of this vesting period is added. That means that the shares will come to you slowly over the period of 4 years, little by little, every year. 83B election is a tax law which says, is a US tax law which says that you will pay your income tax on the price of the share on the day it is granted versus on the day it vests. Section 83B election is optional. By default, it's the other way around, that your tax will be computed on the day of vesting. Now, now here's a very important thing. 83B election has to be opted within 30 days of when you will issue yourself the shares. So within 30 days, your document should reach to the US tax office, and if you miss that, then you may lose millions of dollars in taxes. Okay, so remember this, very important. Now I want to show you an overly simplified math of how this works. Say you are given 100,000 shares of the company at the time of incorporation. So at the time of incorporation, of course, your company will not be worth much. So maybe these 100,000 shares of your company are worth only $1,000. But say they vest after 4 years, all of them together vest after 4 years. So after 4 years, of course, your company would have grown a lot. You would have raised multi-millions of dollars in investment, and a lot of progress would have been made. Let's say these $100,000 of these 100,000 shares now are worth maybe $10 million. So on the day of vesting, like after 4 years, that particular day when it vests, suddenly when these shares will be issued to you in real, it will be actually $10 million of, it will be considered $10 million of personal income, even though you do not get any cash, but in the shares it is your personal income. So on that $10 million, you will have to pay a 37% income tax. This will be a personal income tax, so 37% income tax, plus maybe federal plus state tax also, and that will be like $3.5 million you have to just pay in tax. But however, if you would have elected for this 83B, then you would not have to pay any tax at the time of vesting, but you would have had to pay only a very, very, very tiny tax at the time of granting. That is, when you were granted that year, remember 4 years back when you were given $1,000, at that time it would have been considered your $1,000 income, and you would have paid 37% tax on it, and you would have paid just $370 instead of $3.7 million. So that is why it is very important. Now, this is a very simplified case here. I have not assumed any capital gains tax. So by the way, if you are running a startup which is qualified under qualified small business scheme and you hold the stock for over 5 years and you sell your stock only after 5 years of holding it, then your capital gains tax could be zero. That's why this calculation is still valid in some best case scenario. In a more practical, lesser than best case scenarios, then your saving will be the difference between the income tax and the capital gain tax on some amount, which will still be significant. Now, I'm not going into that calculation. I also omitted some finer points like strike price and some other things, but I will actually post a link below where you can actually read a more detailed calculation, or actually do more search and you will find even more nuanced calculation. So I just wanted to make a point, because in almost every case, at least for a founder, it makes sense to elect for this 83B, and this you have to just do within 30 days of granting yourself the shares. So after that, if you miss it, then you're gone. Nothing can save you. So that is why I just wanted to make this video. I learned this today. So I'm in Canada and I'm myself going to register in USA for the reasons I mentioned in the beginning of the video. So even if you are in India or China or wherever, you should also register in USA if you're planning to do a B2B SaaS company. And if you're not living in USA right now, so you do not come under the US income tax law, it is still better to opt for this 83B election and pay your tax on the share granted to you now. That will be $370 like we computed before, because in future, as your company will grow, you will raise funds from the USA, you will come to meet and set up office in USA. So you will actually come to USA sooner or later, and then you will regret not having made this choice. So this is only a one-time decision to make in the beginning, so make it wisely.